Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, August 8th, 2022. Here's what I'm going to do in this video. I'll try to rifle through these as quick as possible, but would like to pack in some of my favorites right now where I think the trading opportunities are. I'm going to start out with the equity markets as I usually do. About the only thing that has changed there in recent weeks or even months is the fact that all along, since we made the pivot back here on June 16th, right at the lows, covering last of all shorts and starting to go into longs for what I describe would be a swing or trend long. And initially, I had us doing something like this. This was always my max, or these were and still are my max targets. The 200-day moving averages, there's the blue line is the simple, red's the exponential. We're at that. And this downtrend line, that was a biggie for me right here. And so what I figured we'd probably do is come up here, get a reaction, because that was a big level. And we had a little bit of a reaction, but it was more like flagging or consolidation. I'm referring to the initial tag of 317.35. We hit it last Friday, traded off there for a couple days, Monday and Tuesday, and then had a breakout candle on a Wednesday of last week. And so here we are. So what happened is we got the reaction there. It just wasn't it came in the form of a consolidation or a pause instead of a pullback with one last thrust up to those levels. Now look, there's nothing written in stone. We can still go up to the 200 simple. That's what capped us on that advance, as pointed out at the time, that one there. But again, this is a confluence of resistance. You have the 200-day exponential, which quite often acts as resistance, especially during bear trends, and the primary downtrend line off the high. So where I'm going is I am now more open to the possibility that's it. And instead of getting a little pullback here, which again we still could get, that could be it. That could be the end of the run because my initial targets from this point in time were hit. And so instead of doing that and then coming back up again, like I had been talking about for the last few weeks here, that may be it. I mean, I don't expect a straight plummet from here, don't get me wrong. And I even said a couple weeks ago, about a week or so ago at this point, back almost exactly then when that was hit a week ago, that at best I think it's a slow slog from here and we may grind around for a while. I think the easy money has been made. In other words, we sheared, I believe, the vast majority of the meat off the bone from what I still believe to be a bear market rally from here to here. And so at best I see a mountain of resistance and again, best case scenario, a slow grind higher market from this point. And at worst, and quite likely, that's it. End of the run. We start going lower now. So I've made it clear that I started scaling into shorts from this point and continue to hold on to those shorts and even add today. Let me show you. Let me just get to the 60-minute charts, then I'll jump to the sectors and everything else I'm going to cover. Oh, by the way, here's what I plan to cover for you. I should have covered that initially in this order in case you want to skip ahead. And it's in no particular order, it might not even be related, but I've just written down here I wanted to cover equities, the ag commodities, particularly the grains, precious metals and miners, crypto, lumber, and crude. That's everything I've been covering lately. Time permitting, I'll hit on natural gas, but this is a chart I got out to you this morning on QQQ, 60-minute chart. So the way I have this one drawn, you can see my downtrend line's a hair higher. And that's what I said this morning. And it comes in with 330 resistance. So again, it's everything I said last week. The upside appears minimal, and even now at this point, minuscule, less than 1% to big resistance. Again, no guarantee that stops, but it's these divergences that tell me that most likely we're going to get another leg down, and an initial swing target before you get some really good buyers. If we can come all the way back down to that trend line and 296, I'll tell you that's really my sweet spot, my preferred swing target at this point in time, and that takes us down if we get there about 9%, 9.5% from where we're at right now. And if we pop up, fill that, make a full tag of that level there, then that makes it about 10%. All right, that's that. Nothing new there. I got the chart out, post out to you this morning on that. Same with the small caps. Small caps are carrying through that wedge right now. probably be an overshoot is my guess. When you look at the weekly chart, we're a hair above my former T1. Remember, this was from the highs here, the first target 192-ish, 192.15 on IWM, and we hit it and we consolidated for a while. We had that period of consolidation, then we broke it. We back tested once, went on down here, almost hit that third target, and we're back there. And you can see here, there's that 200 exponential moving average, which again on a weekly chart is going to be a 40 period because there's 5 days in a week, so 5 times 40 is 200. So you can see here it acts as support during bull trends, and then when you break it, it acts as resistance from below, and that's where we're back to now. So we have price and trendline resistance. So yeah, still liking the IWM short. It's a little bit underwater now, but not by much. And we had just the breakdown only came on Friday right there. Or no, was it last week? Yeah, it was Friday. There it is. Friday's breakdown and back test. All right, so that's that for the equity markets, and that's what I'm focusing on. Told you I'd go to ags next, the grains. Not running yet, but here's what, I still believe that we are in the early stages. Just a couple months ago completed the initial leg up in a new bull market in commodities. I should have had that chart up, and I've showed you various here. I can do that real quick. I can show you DJP. This is a broad-based commodity ETF. You can go back for years and see that commodities have been in a primary bear market until the COVID lows back in March of 2020, and then embarked on what I believe to be a new bull market, and this is just the initial leg up, really. And that, a lot of evidence supports that. Simply price action alone, the fact you took out a lot of previous highs, and this is just one of many commodity ETFs. And there's your primary bear market downtrend line. Some other commodity ETFs and commodity indexes will go back longer term. And so this aligned with everything I talked about with the rally we'd get, that abation inflation that was not priced into any of the data that came out that the Fed's using or anyone else is talking about. This is my real-time inflation indicator, and it meshed with the rally we had in the stock market. But you got to look ahead. And we broke down here in the commodities, and we had that relief, oil and gas and food and just about everything inflation related. We could tick up, and we could still have one more thrust down. Now, let me just say this. If we get that other thrust down, that will be a headwind for the stock market. Headwind doesn't, I'm sorry, my apologies, guys, a tailwind. A tailwind helps things carry along. It doesn't necessarily guarantee the stock market will go up, but it would certainly, again, be a tailwind for commodities. And if we get that one last thrust down, it would be a great buying opportunity for commodities if we go down there. We may or may not go that low. In a bull market, they don't always let you back in. But if we did, then that would maybe carry the equity markets a little higher, maybe up to that 200-day moving average that I gave you as a potential target, and then get the next leg up in commodities. But the ones I like right now, I think it's a stock pickers market, if you will. Pardon, that's not really technically correct. Let's say commodities pickers market in the commodities arena. Me, I've been short some of them lately, long. I go short, long, energy, natural gas, crude. And then the ags. Let me just cover the grains I've talked about for a while here. Wheat. And wheat's not really running yet, but it's still got a pretty constructive chart right here. This is a hourly chart, 60-minute candles, and you've had a series of buy signals. I've been highlighting it here, and these divergences are getting bigger and bigger and bigger. And so here's what you want to watch. We've been taking out a series of downtrend lines, and the next one to be taken out is this one right here. You can replicate this. This is ZW, 60-minute chart of wheat futures. WEAT is your ETF. Big level there. We've already hit it. That was the first target before 840 3/4. We've hit it a couple times, right? Actually several times. So that would be the next logical target. But if and when we break it out, which I expect, and then we take out this primary downtrend line, that should open the door for a bigger move up, a pretty nice run, I think, in wheat prices. And here's the ETN for you. It's not an ETF. Technically, it's an ETN. Long-term trendline support right there. This is what I'm talking about, guys. This is a bull market. This was a bear market in wheat and just about all other things commodity related that ended when COVID hit. And then you started taking out, it was first of all priced in that we were going to have a major trend reversal, i.e. new bull market. This is a weekly chart. And then you started taking out all these previous highs. So this is just the initial leg up. Got a little buying climax there. Everybody jumping on board the commodity train. Didn't want to buy here, here, here. They wanted to buy here. And then, Russia invading Ukraine, one of the largest wheat producers. And then boom. And so that's where we're at. And say what you want about what Russia's going to do, what Ukraine's going to do. You're at a primary bull market uptrend line. To me, that's buy all day long. And if there's some support just below, if they happen to shake it out, ideally you want to see it hold, and that's that. Let's just not overthink it. There's your primary trend line on the daily chart, and that's where I started throwing wheat out a few weeks ago. We had one leg up. We're still back there now, so it's an objective long entry once again. And the grains move together roughly because they're in a sense competing food sources. Corn, wheat, and soybeans. Those are your grains. You can trade all three separately, or you can buy JJG, the grain ETN, and that's also pulled back to price support here after breaking that trend line there, and probably has another leg up. So here's corn, CORN is the ETN. Threw it out recently too. Yeah, we already hit that first target. But again, probably see some more upside here because let me show you the 60-minute chart. ZC, corn futures, if you like to trade the futures. There you go. Already pointed out recently, bullish falling wedge, breakout back test, went up here, got a little ahead of itself. So some little divergences there. So it gave us a correction back to that 584.25. Put in a divergent low, and we're starting to move higher. So I think we're going to still run up here to that 689 target at least, and that's CC, that's corn. Let me skip soybeans now. I just don't even have the chart marked up. These are the two I'm trading. Let's move on, as I told you I would, to precious metals and miners. That is one of my favorite long trades right now. Giving you a lot of ideas there. Silver ripping today 4.2% and taking out the downtrend line. This is SI silver futures 60-minute chart, 3 months of history, hourly candlesticks. There was the downtrend line I've been highlighting. That was an initial target from off this divergent low right there, and it's been hit. So it's silver so far in the last just couple weeks up about 15%. Nice run. And starting to pop above that 2060, pretty big resistance level. And recently, you can swing trade the 60-minute time frame. You get ahead of yourself, you get some divergences, you're going to get some profit taken. Then you want to look for, ideally, you don't always get it in these divergent lows, positive divergence. That was a catalyst for this pop up here. I'll get to the SLV for you ETF traders in a second. Let me just, while I'm on futures, let me cover gold, GC, quick update there. And still looking constructive. GC 60-minute chart, uptrend line right there, and you had some divergences, and they give you a little bit of a pullback. But you're, in a bull trend, dip buyers will step in and buy support. If gold happens to break that trend line, you've got good support here at 1767, 68-ish. But I still see it coming up to here. And ideally, if it can burn through these divergences, that would be quite bullish. And that's just the 60-minute time frame, which gives us kind of the near-term outlook. And then if we go here to the daily chart, something I haven't mentioned in a while. You guys remember back here, well, if you go all the way back and just kind of give you my macro calls on gold, back here I got very bullish on gold with the big divergent low in 2015. That was the bottom. And then watching this level, to me that was a massive level. Talked about it quite a bit. We had boom, 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 a lot of reactions. Said when that broke, gold should run, and we did. That ripped. That was the bull market in gold. Our initial leg, by the way, initial. This was a bull market in gold back here. And again, I'm just for you catching up now or new subscribers. That was a big bull market that with a blow off top, followed by a bear market in gold that ended in 2015. Followed by this bull market, started out with a period of consolidation more so. I talked about at the time, broke 130, ripped up. Right here, that's where I closed out all swing and trend longs and talked about shorting, closing those out because we hit that previous bull market high, major resistance, and expected a multi-month pullback. It was quite a bit more. It was actually almost multi-year, but it's high-level consolidation really in a bull trend. And then all along, even from that point, I listed this right here. It's hard to see now. I've got so many levels here. This box, it was a buy zone between 158 to 164.85. And we hit it several times. We hit the top of it there and bounced. We hit the bottom of it there, had a nice rally, hit it here, and just recently, having extended the box, that's what we hit at that 158. All along throughout this, I said that's the bull trend. I want to see 158 hold, and that's what's held so far. It's a sloppy chart. You turn off all the lines, but you can see that's just a nice level there. That's where the buyers have been coming in for years buying gold, and so far so good, at least over the last couple weeks here. So gold looking good, silver still looking good. SLV, silver coming off that divergent low, support. There were these previous reaction highs in SLV, the silver ETF back here. And I'm obviously bullish on the miners. You get more bang for your buck on the miners. GDX playing out well, up another 3% today. Most recently breaking out of this bullish falling wedge pattern. Nice divergent low there, breakout back test, and still maintain all these targets there. And then SIL, like the silver miners better. They tend to run more, and right now the charts are more constructive, and they're up 3.5% today. But I've also given you my my top picks in that sector and how I'm trading it with a mixed bag of these individual miners. PAAS, Pan American Silver, right at that 2073 level, ready to pop it and run up to the next target there, 2380. AG up 4.3% today, hitting that 836 target today. If it can take it out, which I expect it will, strong charts here. Next target 926. Again, these were all covered recently. MAG, hitting that, look at that, pushing up against that $14 resistance, first target, and opening, we popped those recent highs about 1420, should open the door for a move up to those next targets there, et cetera, et cetera, et cetera. They're all looking good, looking constructive right now, and so that's one of my favorite longs. Crypto here, I'll just hit on it. Bitcoin and the Ethereum, BRR, Bitcoin futures. This is a hourly chart, 60-minute candles. Remember, we have this resistance level here of 24,253 right here. That's that 1, 2, and now 3 reaction highs there. It's given us an ascending triangle pattern right there. If that breaks out, that's going to be bullish unless it fails. And if it breaks out and fails, that is, look, here's how I see it. I think the market is limited upside from here, and I've told you this is a almost a perfectly correlated or highly correlated trade with the stock market. So what I'm going to draw for you here is a little wedge in my preferred scenario. I think we'll get a breakout. It'll be a false breakout, and it'll give us this bearish rising wedge right here. It'll extend these divergences because this is our previous high right here. It's right there where that line is. So any equal or marginal new high will be a divergent high. So if we go up, the wedge could look a little different, but something like that. And then boom, powerful if that plays out that way. So that's my preferred scenario. But look, sometimes a breakout's a breakout. You got to treat it as such unless it fails. And really not a lot of resistance up until that gap, bottom of that gap right there, and then that target. That's still just like the stock market. I have higher max potential targets. That's been a max target, potential target from all the way back here off this divergent low. And again, if the stock market's going to run up at the 200-day simple moving average, QQQ, and the likes, then that's probably where we're going to go in Bitcoin. And then Ethereum, the Ethereum futures, ETH, where is that chart? Got it here somewhere for you. Bear with me. ETH. There it is. ETH USDRR. All right, Ethereum US dollar futures, and this one's taken out the downtrend line, so that's notable. And it's also taken out that 16 right at 1700. That's 1700 resistance right there. But it's done so with divergences in place. So like Bitcoin, I suspect that this is going to prove to be a false breakout, and it's going to set up this bearish rising wedge. And if it falls back below that trend line, ugly, because that's a double failed breakout, aka bull trap. You'll have a failed breakout of that 1700 price resistance and a failed breakout of the downtrend line. So again, as of now, it's a breakout, so you got to be a little respectful of that. If you had no position right now in Ethereum, do you short it here? Absolutely not. If anything, you go long because it's a breakout. But if you're looking to short or add to a short, you wait for that breakout to fail. That would be your entry on it. So again, it will most likely coincide with a reversal in the equity market soon. If the stock market keeps chugging on up and powers through that trend line on QQQ and the price resistance just above, then yeah, I suspect that crypto will carry up to those next levels. But that's, as of now, not my preferred scenario. And then last but not least, lumber and crude. I told you last week I was liking lumber. Nice, just a beautiful chart, beautiful setup, and it's live. You had that previous low. Told you if we undercut that low, which would be likely, we'd have a divergent low, and not just positive divergence, because you have. Let me draw this here. You have looking for my line tool, guys. Forgive me. There it is, positive divergence right there on the 60-minute time frame, and you undercut that low, which gives us three things happen. Well, two things: the positive divergence, divergent low, and a nice good old-fashioned bear trap. Bears are shorting lumber and thinking it's going to go down forever. They short the break of the previous low because they're mechanical traders, conditioned to do so. And then when it reverses, and it reverses strong, all those people, what I call JCL or Johnny Come Lately shorts that pile in, didn't want to short the divergent high there, or the breakdown there, or the breakdown there. They wanted to short here. Well, now they get they see that they're quickly underwater, and their stops, if they were mechanical traders, they shorted the break of the low, and they put their stops just above it in case there was a recovery, and so now those stops are being hit. And we're up to that first target already, 523-ish, and the downtrend line right there, and it's up 10%. So if you took it, you could take profits here at the first target, probably get a reaction there, but we could also carry up here to any of these additional targets. You may want to raise stops on that one. And last but not least, crude oil. Remember, I painted the longer term bearish picture, which has also been fueling this rally that goes hand in hand. I call for the abatement in inflationary pressures. Everybody patting the Fed on the back, saying they're doing the job, and that whole paradigm shift thing. But again, that whole paradigm shift thing has now played out. It's, to many, it's just becoming apparent. But to institutional traders and people like myself that saw it, were down long off the lows back in the middle of June, and are happy with the 20+% rally in the equity markets and many and other things. To me, it's time to take profits and start getting back on the other side of the trade, saying that once it becomes apparent to all what's going on and they want to buy now, that's when you want to start taking profits on the long. So this is crude oil here, and it's getting very close to that next target at 85.45, but you've got divergence setting up. This is the daily chart here, so we may not get there before the next decent rally. And and the market's been rallying on this as well. This has been giving it a tailwind to equities. Falling crude prices of everything out there. This is probably the most bullish commodity to fall in price for the stock market, because obviously, corn, wheat, hogs, cattle, that's going to impact commodity prices or inflation. But energy hits everyone the hardest. And so that's been a boon for the stock market. But again, going back to the shorter term time frame, that's not what I meant to do. I meant to click back on crude oil. Let me find that chart again and go down to a 60-minute chart. And so you can see here on the 60-minute time frame, let's tighten it up a little bit here. You've got these divergences forming right here. And so that could lead to a nice rally in crude oil. So the risk reward right now, though the trend is still bearish, the risk reward is we're starting to set up for potential rally here. I don't have a great trend line to trigger long entry. I just wanted to point out these divergences in play, and this is just it's how I at least swing trade something, whether the primary trend is that's not what I meant to draw. Whether the primary trend is bullish or bearish, you can swing these counter trend rips when you get positive divergences, and then turn around and close those longs and get short when you get the negative divergences. So And right now we have the positive divergences, and that's again one, but not the only reason for being long right now. And then on that too, what I was trying to get at before is, should these divergences play out for a decent rally and carry crude back up, anything, and just once the street starts to recognize a bullish trend in crude, even if it's 10, 15% rally, that would, or at least should in theory, give a headwind to the equity markets. So we'll watch this. And the one I didn't tell you I'd cover, which I should, because I just got a update out to you, is that semiconductor sector trade. So remember back here, put it as a long trade idea right here. That's where it was on that 60-minute chart. It was July 6th. Even though I pivoted long and mentioned, all things tech, and obviously semi was given, but that's where I made that also a trade idea, because I figured the semis would outperform. I overweighted the FANGs, big tech, and semis and tech in general. And it's been, like I said, whatever it was, 20, 21, 22% run off that entry there, from the lows to the highs so far, about a 30% rally in the semis. And so that's it. T4 was the final target. Look, if the equity markets QQQ is going to go up and hit that 200-day simple, then yeah, we're probably going to carry on up there. So that's why I said you can either short it here, it's a little aggressive, or take the more conservative / conventional route, wait for the trend line to break. This is a rising wedge pattern, just like you have on the indexes. So same thing here. The risk reward does not favor being long or going long, especially going long here. It favors getting short at this point in time. Again, it's a trade I think we sheared most of the meat off the bone. Unfortunately for me, I started closing them out here at T2, but I left this on as a trade, and it's still, now that's no longer T4. We can get there. It's just going to be without me. So that's the final target for that trade, and it is now an active short trade. And as I showed you before, I said I'd get some targets out to you, but I'm just, for now, let's just eye that 370, 850, which was the former first target. Very, very good level right there. And I think that's the most likely pullback target if we get a breakdown here and we get some traction going on the equity markets. We need the equity markets to move lower, particularly the tech-heavy NASDAQ 100. And that would be a drop of about 8.5%. And SOXX, like I said, that's the 3-time leverage if you want some juice on it. And just like there's a bearish rising wedge on SOX, of course this is just the inverse of it, but with leverage, and there's a bullish falling wedge, and that would be your bounce up here somewhere around there. Okay, that's it. If that's not enough trade ideas for you, then I don't know what is. That's about all I can manage at one time. All right, guys, we'll wrap it up here. Get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.